Mm. Good evening, class.
Good evening, sir.
You guys are good today. You're welcome to another class on strategic business reporting. And today we are going to be rounding up on analysis of financial statement with more questions. Firstly, we need to finish up the question we started on Wednesday, which is this question on Kakanfo Group PLC. And what the question was about was Kakanfo Group PLC wants to acquire either of these two companies, Gombe and Uzo. So we are expected to advise Kakanfo on which of the companies he should acquire. However, we saw that the companies have different accounting policy. Uzo uses revaluation model to measure its PP, while Gombe uses cost model to measure its PP. So we needed to put the two of them on the same basis by reversing the revaluation that has been done by Uzo Limited. Spent a lot of time on that, explaining revaluation and how to reverse it. Furthermore, we also saw that Gombe sold goods, which he then made an arrangement with the buyer that is going to buy those goods back. We figured also that that type of transaction does not qualify as a sale because as far as IFRS 15 is concerned, he has not transferred the risk and the reward. For that reason, he cannot recognize revenues. So we had to reverse it. And when reversing it, we said it's not revenue that is a financing arrangement. This is as good as he has borrowed money because he actually collected money for the sale. A sale that is still going to collect back the goods. You're saying, since you are still going to collect back the goods, then you have not transferred control. Then you have not sold. So we were able to achieve all of that last on Wednesday. For Uzo, we removed the revaluation that has been added to the assets by removing the 24,000 and also from equity by removing the 24,000. We also reversed the excess depreciation that will have been charged to P&L. We're told that depreciation is charged to cost of sales. And we figured that a company using revaluation model would have charged an higher depreciation, and that higher depreciation is excess depreciation, and we're able to get the excess depreciation as 4,000 from the fact that we're told in the correction that the company usually transfer excess depreciation from revaluation surplus or revaluation reserves to retained earnings. And we're able to figure out that what they transfer is 4,000 because in the OCI, the revaluation reserve there was 24,000. But when we looked at the reserve, the revaluation surplus present in the revaluation reserve was just 20, showing that they have actually transferred 4. out of that 20. So that 4 is the excess depreciation. That's because the excess depreciation to transfer. So this excess depreciation, we need to reverse it. Since it has already been added to cost of sales as an expense, which will have obviously decreased our gross profit further because of the increased expense. In order to reverse this true gross profit, we need to add it back to our gross profit. And whatever affects gross profit will have affected profit from operations. So we added this also to profit from operations. And whatever affect profit from operations will affect profit for the year, thereby affecting equity. Because equity is usually, or profit for the year is usually transferred to equity. Usually transferred to equity, and that's why we were adding this 4,000 as well to reflect the adjustment to the profits, the original profit transfer to equity. Additionally, this total asset, remember they will have over depreciated it still by that excess depreciation, so we added it back. So basically, those were the adjustments we made to reverse the revaluation. For Gombe, the revenue, we reverse the revenue that he made by removing it from here. The profit he made from that revenue, we also determined it. We reversed that and we explained that thoroughly in the last class. It gave us a markup and a selling price. So we needed to do 60 over 160 times 96 to get a profit because it is already at 160. So when we determined the profit, we need to remove it from this gross profit. So that was why we deducted it. Then if profit from operations, because anything that has affected the gross profit will affect the profit from operations. We need to remove that profit also. And anything that affects profit from operation will affect profit for the year, which is transferred to equity. And that was why we removed it as well from equity. The question asks us for justification for the adjustments. And majorly, they need you to explain the adjustments you have made. And you need to tell them that we deducted 24,000 from total assets and equity because it represents revaluation surplus that was initially treated on these items. So we need to reverse the initial treatment. Additionally, we added back depreciation. We added back the excess depreciation of 4,000 to gross profits and profit from operations because the evaluation would have resulted in over depreciation. So this needs to be reversed also. We also adjusted the over depreciation on the total assets as well as the equity. So this is in the books of Uzor Limited. But in the books of Gumbe Limited, we removed the revenue. We removed the revenue from the global revenue because of the repurchase agreements. As this should be treated as a financial liability, hence it should be added as a loan. That we did not do. We're supposed to add in the book of Gombe that 96 should be added as a loan. So loan note 64, loan notes 64. We need to add that 96 should be treated as a loan. If you add 64 plus 966, that's 73,600. Additionally, we remove the profits that was made on the sales of 36 from the gross profits and the profits from operations as well as equity. Because they are unrealized. So the B, that's the A part of the question, asking us to recalculate, to carry out necessary adjustments. The B part of the question, we're asked to recalculate the 4 key ratios for Gombe Limited and Uzo Limited using the new figures obtained. Okay. Now, B, they want us to recalculate ratios for Gombe Limited and Uzo Limited. And what are the key ratios they want us to calculate? 4 key ratios: gearing, turnover to capital employed, Gross profit margin, return on capital employed. Let me start with Jared. So, gearing ratio, as you all know, is debt all upon debt plus equity times 100. And what's our debt for Gombe Limited? For Gombe Limited, we already have a new debt that we calculated. That's 73,600 over debt plus equity. Equity also, we have a new figure, 9,400 times 100. For Uzo, what's the debt of Uzo? We didn't adjust the debt of Uzo, so it remains 72 million. This is in thousands. So let me do something like this. Okay, 72 over 72. We adjusted the equity for Uzo to 68,200. 68,200. Hey, okay, can you give me the ratios? Waiting for you. Give me the figures, please.
Will be 45%. Uzo 51%.
So the next ratio is turnover to capital employed. Turnover to capital employed. And what's the formula for this? From the name, we can know the formula. That's turnover all upon our capital employed. And my capital employed, I'm going to get it as debt plus equity. If I wish, I can use it as debt plus equity, and I can use it as total assets. Either one that you use is fine. Whether you use it as debt plus equity or use it as total assets, you are good to go. For Gombe, I did not adjust his revenue. No, I did. Where is it? Yeah, I adjusted his revenue, Gombe. So his new revenue is this 262,400 for Gombe. And the revenue of Uzo, um, Uzo is 264,000. That's the revenue of Uzo Limited, 264,000. The capital employed is just what I've calculated up here before. Debt plus equity. And this one, debt plus equity. Okay, so what I wish you?
For Gombe, 1.6, approximately 2%.
Oh, it's not in percentage. Turnover on
Okay,
capital employed is not in
okay,
percentage.
okay. Yeah,
One is to six
1.6
to one.
is to 1.
No, it's not 1.6 to 1.
Is it measured in times?
Yes, it's measured in times.
Okay.
Correct. How about this one?
One 1.8 times. 1.9. 1.9 times. Uh,
Then the next ratio is gross profit margin. And what was the formula for this?
Profit before interest and tax all over revenue, all over sales, times 100.
No, it's not profit before interest and tax. It's gross profit over sales. For Gombe, we have already adjusted his gross profit to this. And his sales, you can pick it up here, is 262,400. times 100. And this one, how much is this? For Uzo. What's the gross profit of Uzo? We adjusted it yet too. And this is 84,200. Over sales. What does it come to? What sales? 264 times 100. So how much is that? In my figure.
38.3.
How about this?
Excuse me, I'm getting 32%.
Okay, for this one.
Okay,
Okay.
no,
So for
is the other one, the second one. I
Uzo,
think, yes,
you got 32.
yes.
Okay. Then we have returns on capital employed. What's the formula for that? Profit from operations. All upon.
So I thought it was profit before. Okay, same thing. Yeah, sorry.
So for Gumbe, we already adjusted the profit from operations. Over debt plus equity, which I can pick from here. Times 100. For this other guy, who's up? It's 28,200. We adjusted it. All upon the addition of this. Times 100. So what do you have?
17%. Yeah. Is
For
it
which one?
2% for Gombe?
The first one. 17
Yeah.
points.
No, it's just 17.
Okay. How about for Uzo?
Okay. 72,068,200 equal then 28,200 divided by 20%.
Okay. So let's start with the journey now. In journey ratio, based on what we have computed, between Gombe and Uzo, which is better? Between Gombe and Uzo, which is better? In terms of journey.
Gombe, I think Gombe is doing better.
Okay, that's correct. Because it will be less exposed to financial risk. Only 45% is capital structure. Only contains 45% debt. Why this one has 51%? So Gombe is better. But before the adjustments, who was better? Well, it was still Gombe that was better, even before the adjustment. It was still Gombe that was better. So, as far as Jaren is concerned, this adjustment didn't bring about any major change. Now, this turnover on capital employed between Gombe and Uzo, who is better?
Uzo.
That's
Uzo.
correct. That's correct. Uzo is more efficient because he can convert his assets to sales 1.9 times. Let's see. Before the adjustments, Gombe was actually better, but after the adjustment now, things has changed. Okay. In terms of gross profit margin, okay, obviously Gombe is now better, but before adjustments, it was still Gombe that was better. It was still Gombe that was better. Okay. In terms of ROCE, Uzo is better. Uzo is now better. Before the adjustment, Gombe was better. So you know that if you look at the last paragraph of this question, they said, no, the second to the last, you know that the senior accountant already said Gombe is better than Uzo based on these ratios. But now that we have recalculated this ratio, the C now, the C is saying we should evaluate the senior accountant's conclusion in the light of my answer in A and B. Of course, my answer in A and B, a lot has changed. Even though Gombe is still better in terms of gearing, because he doesn't have as much depth as Uzo has, but the difference is not much. But when it comes to efficiency, profitability, Uzo is now better after the adjustment. Even though the difference is not much, but Uzo is now better. He's more efficient. In terms of gross profit margin, in terms of direct cost management, Gombe is still better. Gombe is still better. But in terms of return on capital employed, and you know that return on capital employed is the actual, not the actual though, but it's a representation of the returns shareholders would get. Now, Uzo is now better. Uzo is now better. So if I'm asked to evaluate, all I just need to do is just to analyze it of this ratio. And I make conclusions that in terms of shareholders' return, Uzo is now better. In terms of efficiency, Uzo is now better. Though Gombe is not as geared as Uzo, but their gearing is high, the two of them. And Gombe manages a cost of sales better than Uzo, but it doesn't really translate it to returns to shareholders as Uzo does that better, right? And that's the evaluation I would do for the C. So I would say for the C, if I'm asked to evaluation of the senior accountant's conclusion. Uzo Limited, or Gombe Limited is still better in terms of gearing, though the two entities has a relatively high gearing ratio. However, Uzo Limited has a favorable efficiency ratio with respect to turnover to capital employed, and it makes a higher return to its shareholders. Though Gombe Limited makes more profits, makes more gross profits on every sales, but it is unable to transfer the cost management to the profit from operations. What's his name? Uzo Limited is able to manage its costs, its operating costs, thereby impacting on its profits from operation. Uzo Limited, following from the above, Uzo Limited appears to be a more profitable and efficient entity, and should be considered as a potential target for acquisition by Cancanfo Limited. Okay, so which is a little different from the senior accountant recommendation, because he made his recommendation before all of these adjustments. So it's okay. Now, November 2024. Now, this question in November, it says that prepare a report analyzing the financial performance of Aracom or Arocom and its financial position for the year ended June 30th, 2023. Advise Alhaji Kyari, the chairman of your company, whether the company should consider these investments. And also asked for forecast year 2024 profits for the retail operations using business outlook. In total, we have 20 marks. Okay, I can see that they want us to prepare reports. And We're given the financial information of Aracom. So I was given his P&L. I was given his P&L. I was given the statement of financial position for 2 years. And I was given the segment information for retail operations, online stores, associate contracts. So these are, they say there are 3 business segments. So they give us their revenue information and all that. Okay. Okay. This is just like the breakdown of this revenue, guess. So they give us some background information. We're told that the company, Arocom, has been trading for more than 10 years, producing and selling children toys to the public in its 15 retail shops and other retailing customers. Arocom Nigeria Limited revenue and profit have been very stable over the last 10 years. However, about 1.5 years ago, a newly appointed sales director saw an opportunity to sell the product online. So what I can see here is that this guy, Arocom, has been trading for a long time. He has been in this business, producing and selling toys. And he has 15 retail shops. The company's revenue and profit has been stable over the last 10 years. But 1 year ago, they got a new sales director. And the guy brought in online that they can sell online. We're also told that the company uses long-term funding to set up an online shop. And the online shop has been operating for 14 months. The sales director also used his personal connection to secure a lucrative deal with the Save Our Children home across the country to supply customized children's toys. The contract was signed on 4 January 2013, which year we now June 30th, 2023. Oh, he just signed it this year. Okay. The managing director of Arocom is of the opinion that more markets can still be explored with the online market and contract with SOCH. Okay. However, their bankers are not willing to grant further long-term loans and overdrafts because the company has insufficient assets to offer as security. The existing funding is secured on Arocom Nigeria Limited's PPA. Okay, so banks are not willing to borrow their money, even though they want to expand, but nobody's giving them money. They have insufficient assets to offer as security. So the managing director of Arocom has therefore approached a wealthy personal investor, Olaji Kiari, the chairman of Jolimag Investment Co. Limited, for financial assistance for Arocom Nigeria Limited. So we want Alaji Kiari to give us money. Now, the business outlook for retail operations for the next year is as follows. Due to improved price patronage, credit sales, which is made up of 70% of credit of current sales, is expected to increase by 20%, and the remaining cash sales will increase by 10%. All related cost of sales are expected to increase by 12%. Related bad debt written off is expected to be 10% of the credit sales. Now say that as the accountant or chief investment analyst of Jolimag Investment Limited, you are required to prepare reports analyzing the financial performance of Agrocom. Okay, so you work for that Alhaji Kyari. Alhaji Kyari is the chairman of Jolimag, so you work for him as an accountant. And this company has come to your chairman asking for money. So you're supposed to then do a report to your chairman, analyzing the performance. So let's do a report to our chairman. But before we run doing a report, I really want to tell my chairman about financial performance. So basically, I would basically talk about profitability of this company and efficiency. Obviously, they don't have money. They need money. So liquidity, I don't expect much of liquidity from them. So I won't bother computing any liquidity because even if you look at their cash, you see that these guys, um, kobo they don't have. It's zero. They don't have shishi. So it's quite clear where they are. And 272 in bank overdraft. So it's clear. See, their liquidity situation is not in doubt. So I won't bother investing myself into seeing much around that. Seeing that they are in overdraft situations alone already shows that they are backward. I can say a little bit about their gearing because I need my boss to know. I need my chairman to know that do you really want to put money into this company? Look at how much they have borrowed already. That's if you sink in money, this is the likely risk. This is the likely risk. So he needs to understand the level of gearing of this company. I'll do gearing as well. So I'll majorly do um 3 or 4 ratios for profitability. Then I can do efficiency. I can just do asset turnover for efficiency. Then that would that should do for me. Yeah. Then I will do some analysis. Then in doing my analysis, I was given a lot of context. This company has been operating, yes, a lot of shops and all that here. So I will just call this my appendix. First, let me see how well he manages his cost of sales through gross profit margin, which is gross profits over sales times 100. And how much is my gross profits? 7668. And how much is my gross profit here? 4440. My sales, how much is my sales here? 24 and 48. Okay, so who can tell me? What's my gross profit margin?
34%, 32% for 2023. 32.
32%.
Yes.
How about in 2022?
3%.
30%.
30%.
30%.
30%.
30%. Okay. It's improving in terms of cost management or cost of sales management. Let's see if we can translate that to operating profit management or operating expense management. So let's do operating profit margin. So operating profits over sales times 100 over 1. So what's my operating profits? Oh, what is it? How do I get my operating profit now?
You say
Hmm?
profits for the year, then you add back interest expense. Okay, but there's no interest. Yes, there's interest expense. Profit for the profit before tax, then you add back interest expense.
Thank you very much. Absolutely correct. So 2160 plus 172. Because to get this 2160, they have deducted these costs. So what I need is a profit before deducting this cost. That's what I need, which is the PBIT. I'll do the same thing for 2022, which is 1228 plus 136. Then I divide it by sales, which is 24,000. And this one, 14,800. So what do I have?
2023, 9.7.
2023, 9.7.
2022, 9.2.
Okay, not bad. The guy is still improving in terms of costs also. He's making more profit on every, he's improving. So let's see right now is returns on capital employed. Let's see what return is doing on capital employed. Let's use the same profit from operations, operating profits divided by debt plus equity times 100. So I'm just going to copy this that I've done before. Then debt plus equity. Equity is 5088 in 2023. Debt is 1648. 5088 plus 1648. While in 2022, this is 4640 plus 1616. So what do we have as return on capital employed?
34.6% for 2023.
Okay. Now 2022.
23%. Sorry, 22%.
Okay. Guy is improving. This guy is a very profitable company. It's a profitable company, no doubt. Let's even do how many times? Let's do turnover on capital employed. Let's look at efficiency. How many times it can is able to convert his asset to sales. Let me use debt plus equity. So you don't need to be computing again. I have sales here. And just use it. I have debt plus equity here. And just use it. So let's get how many times for 2023 and 2022.
Three point six times.
2.6 times.
3, sir. 3.6. 3.
Okay. What about this one?
2.4 times.
2.4. Okay. You see that this guy is still improving. Is efficient also. So let me check his gearing ratio and see so I can advise my boss appropriately. I know that his depth is 5088. Yeah. I know that this one is 4640.
Sorry to ask a funny question, but I wanted to, is it not supposed to be like profits that we're supposed to use instead of sales when determining like returns on capital employed and things like that?
Yes. We use profit here. Okay. This is
So what's
return on
now the
capital.
point of the second one? Sorry.
You know that this measures return to your shareholders. You want to measure his ability to make profit from the capital we give him. These investors are interested in this. That how much is this guy going to give to us at the end of the day? This one is efficiency ratio. This one is what we used to call asset turnover. So you can find the examiner calling it, like in the last question we did, they specifically called it turnover on capital employed. So this is still looking at its efficiency in terms of revenue generation from his capital. Okay. How many times can he convert his asset to sales? This one is how well can he return um, to shareholders in terms of its profitability. So we can see this as conversion of capital to profits. This as conversion of capital to revenue, right? So there are two different hands. Right? One is more focused on profits. One is more focused on efficiency, because it's efficiency that will translate to good profitability at the end of the day. So yeah, they are quite different and useful
Thank you,
for
sir.
for performance. Okay, so now let's see if we can talk about performance and position of this guy with what we have here. So we are writing, you are the accountant. Okay. I'm writing it to the chairman of Julimag.
Sorry, sir. They did not write the figures of the gear ratio.
Yeah, give it to me.
%75.5% for 2023 and 74.2% for 2022.
Okay. Yeah, almost the same, but the guy is highly geared though. He's highly geared. Guys, too geared. So let me write the date of the balance sheet. You can write your exam dates because nobody will really bother you that much.
Sir,
So
I wanted to ask, since the company is very profitable, but they are highly geared, will it be important to like know if they can, if their profitability can still cover interests? Because one thing that like investors want to look at is, okay, since they are highly geared, but they are still highly profitable, can they make up for that debt? Can they pay back the debt so that they'll know whether their money is safe or not?
I agree with you, Fashion. I fully agree with you. I think we should do that. We should do interest cover. I agree with you, and you should always do it. So he has made a very valid point. Moses, I saw you had, I thought you were going to ask a question.
Yes, Mr. Fatch is not asked my question. That's what I want to
Okay.
ask as well.
Okay. Nice,
Okay.
nice. Yeah, you guys have made a very valid point. You need to be able to say that. So the operating profit is here. And here too. So this is 172. Okay, let's calculate this. How much?
23 is 13.6 times.
Hmm. Wow, that's very good. 2022.
Is 10 times.
Wow, that was very good. I mean, everybody will agree that this guy is very profitable. And we should give him the money, really. This report,
Hello, sir. Sorry.
yes, Moses, go ahead,
Yeah,
please.
mainly looking at the interest cover. We pick the figure from profit or loss account. What if the company is unable to pay the interest and is accumulating it in your balance sheet, and the balance sheet is not giving to you? How do you go ahead and say they should give them the money? Probably the interest rate is being accumulated. They are not paying it, but they always recognize it in their profit or loss account every year.
Okay, that's a good question, Moses. So the answer to that is that they don't have money. That's why they are not paying. Okay, they don't have money. They are not liquid. If they were, they will have paid. Are they profitable? Yes, they are. Why are they not liquid? Because they're expanding. They're expanding. They have different segments. They're
Maybe
investing in,
they have a lot of receivable now. Look at it.
yes, they may have a lot of receivables too.
Or they are investing most of their money in the capital expenditure.
Yes, they are invest because they are opening online stores and all of that. So, but they don't have so much. But I can see here that their admin cost is huge. Their distribution cost is huge. You can see
Sir,
that. Yeah.
hello, sir.
Yes,
Since
Echo.
the since the gearing level is this high, will it be appropriate for us to advise them to convert some of their debt to equity?
Oh, yes, they can. It's a good approach. We can actually advise them to do that. Um, but you know that is not the focus here. The focus is we are working for this chairman that is considering investments in them. So our thinking should be around that, whether we should advise this guy to invest or not, right? And from the point you guys are raising, there are a lot of talking points around here. There are a lot of ratios I want to compute. I'm just trying to manage my time, considering that I have 12 marks in the exam. I don't want to spend all my time computing ratio. Where if I wish self, I might not compute ratio self and still get good mark. If I can do a very good trend analysis and I can compute this ratio somewhere like that, like the point Moses was raising around high level of receivables and all that. So all that I can use as my talking points. But ultimately, in terms of financial performance, is this guy is this guy profitable? Yes, he is. Is he liquid? No, he is not. Can this guy make revenue from the money we give to him? Yes, he can. Why is he not liquid now? Because he hasn't collected his money back from his receivables because he's spending a lot of money on distribution expenses and all that, which is why, that's why he's not liquid, but he needs to find a way to liquidate his receivables. He needs to find a way to collect. And why he's having a lot of receivable? Probably because, he got government contracts and it's not like government is going to give you your money outright. They will give you much more later. So, yeah. So the fact that he has cash lying down shows that there's an opportunity for potential liquidity reserve if those money comes in. So that's also a plus for him. He has a lot of debt right now. That's a concern, right? That's a concern for us. But considering that he's able to convert those borrowings to profits, he can convert them to revenue, then paying back will not be a problem. All right. So his position in terms of gearing is looking concerning, but he has the profitability cover. So that the financial risk is not there like that. It's not there because he has the profits. If you give him cash, he can settle those ones. If he collect his receivables, if he sells more, this guy is a cash cow. We should invest in him. So this report is prepared for the chairman. What I'm doing right now is introduction. In every of your reports, you do an introduction, and introduction to your report talks about the purpose and scope of the report, who the report is meant for. Introduction talks about the information you are using and all of that. But for you, it's just majorly the purpose and scope and the person that requested the report. That's all. So it's prepared for the chairman, and the purpose is to analyze the financial performance and position of Aramco to enable the chairman of
Yes, sir.
Julimag make investment decision. The basis of the analysis is on the ratios computed from the financial statement of Aramco. You see that. Number one is that you can see here that the revenue of Aramco, the entity, increased. And this is not a small increase. So this is a significant increase. So I want to do a little of a trend analysis. And why I'm doing a trend is because of the level of increase this guy has. His revenue increased, and it's not surprising because he has increased his admin and distribution expense. And this as a result of the expansion into online stores and the deal he got. Okay. And ultimately, he's able to convert this to profits because it increased. This is like almost X20. It's like X20, right? Like 20 times increase. So I need to speak to that very, very smartly. Then I speak to my ratios. Then that's it. I then conclude. So you need to have what you want to say in mind before you start writing. Sam, I can see you, and please ask a question.
Okay, sir. Good evening, sir.
Good
I
evening.
noticed that you did not compute for liquidity any of the liquidity ratios.
Yes. I didn't. It's intentional because it's very glaring here. I'm going to speak to it on trend analysis, right? This company clearly does not have cash. I don't need to waste my time computing liquidity ratio because of the nature of this. I will speak to it. It doesn't have cash. Look at it, it's zero. So it's clear. Though it's not liquid. He's in a negative cash position. C is overdraft. And that's why I didn't bother computing it. It's clear, it's glaring. It's glaring. And why I'm doing all of this, because its profitability nature so also is also glaring, but there are instances where you would need to do ratio helps you. For liquidity, the ratio will not say more. Position is your position, right? Which is you don't have to, if you see that this guy does not have money, the liquidity ratio will not change anything. But when it comes to profitability, it might be so profitable in terms of revenue. But by the time you put the revenue to gross profit, then you discover that this guy is unable to convert this revenue to gross profit, probably because he has incurred a lot of costs. So gross profit margin becomes useful. Operating profit becomes useful to assess his level of admin cost management and also profit for the year also. Like that. The engineering ratio, I can't just look at his debt. I need to look at it vis-a-vis equity to see where he is. And of course, the interest cover to eventually speak to financial risk. Yeah, good point you've made there. So you see that the revenue of the entity increased significantly, right? If you don't want to waste your time doing percentage, if I want to do it, I can say increase by so percentage if I wish. But here is a significant increase. So if I want to even show the examiner that I'm a very good analyst, I can see that this is almost times 2 increased by almost, you can say x2. X2 is almost, it's not times 2, because times 2 would be like 29, 600 or thereabouts, and this is just 24. So they're almost x2, but I mean, increase significantly year on year is okay. And it is able to convert this revenue increase to gross profits.
Thank you, sir, for the explanation. So I had a network problem.
Sorry. You're welcome back anyway. To gross profits, operating profits, and profit for the year. As all these levels of profits increased significantly as well, furthermore, the gross profit margin increased year on year, showing a good cost of sales management. However, despite increasing administrative and distribution expense, the entity was still able to maintain a strong operating profit margin. So, which is very good because his admin and distribution was increased, but he still has a strong operating profit margin. See, and needless to say, the entity has an ability to return, to make good returns. Good returns for its shareholders, for its or to its providers of capital. Judging from its return on capital employed. And similarly, it is able to efficiently convert its capital to revenue. Not just 1 year off, but year on year, it was increasing at a good rate. It is noteworthy that the company or the entity is faced with liquidity constraints as shown in its negative cash position, and it's increasing trade receivables and trade payables. However, if it can recover its funds from the receivables, it should be able to settle its suppliers. The level of gearing is worrisome, but there is no financial risk here because it has a strong operating profits to adequately cover the finance costs by over 13 times in 2023. Yeah, 13 times in 2023. This shows that if the company has access to funding, it will settle its finance costs and debts, and considering its history of profitable and efficient operation, it will convert the provided liquidity into revenue and profits for the providers of capital. Following from the above analysis, hold on, I'm not going to jump. Advise query whether your company should. Okay, I think I'm done with this because the way this question is structured, this one is separate. So B, following from the above analysis, I recommend that we should consider an investment in the entity because it is profitable and efficient. And from its profitability and efficiency ratios, it is clear that it will provide adequate return on capital employed. However, we need to ensure that it does not obtain further debt instruments as this may expose the company to financial risk and we should ensure that it settles existing debts so that the assets of the company, of the entity, will be without encumbrance. Because right now it is encumbered. They have lien on it. Let the asset be free. Let the asset be free. Okay. Fashito, you have your hands up.
Yes, sir. So I know that like in exam I won't really bother about what I want to ask, but I just want to ask that because what is it called? The interest that is supposed to be paid by the company compared to the loan or the debt they received is like suspiciously low or something. Is it not like something that should be like the investor should be skeptical about? Maybe as like maybe a something that can indicate padding of financial statement, especially because the revenue that we are saying that we are seeing, we are not yet receiving any cash from it or serious cash from it because of the increase in trade receivable and the like. So that's what I was just looking at, that maybe outside school or something, people can be considering that.
Okay, yeah. You have made a point, but your point is not supported with data, supported with assumption. So we cannot talk about padding and all that because there's no basis for that. So that will not be that's not recommended for us, but because based on the data we have, there is nothing suspicious about his level of increased profitability. Is well, all we can see is the guy is making good revenue and he's making good profits. That's all we can see. And it's clear why he's making such level of profits because he has profitable segments. That is why. So we will not, it's not recommended that we speak to that in that manner. Okay? Yeah, Moses.
Yeah, sorry, please. If I might ask, in the case of exam, when we look at this profitability level, if I carry out trend analysis to also explain my point of future about the business, I don't know. Is it acceptable to carry out my trend
Yeah.
analysis on it?
Yes, it is acceptable to an extent. Okay? It is acceptable to an extent. So trend analysis would work for liquidity ratios. Trend analysis would work for liquidity ratios. Um, and you can use trend analysis to see the movement in costs, revenue, and profit. But to really know profitability and efficiency, you need those three ratios. So in most instances, you have to compute these three ratios for profitability and use this for your efficiency and these two for your gearing. So measure your financial risk, then you speak to them. You just speak around. So in your analysis, you can then speak to the trend that you could see and say, this company this is increasing, this is decreasing. If in fact I could say more if I wish, because there's a lot of things that I want to say that I'm not saying here, right? So yes, I mean, needless to say, I really do not, it can make good return, right? And all of this is clear. The reason why he's having increasing expenses is clear. It's because it's expanding. They are going into online stores. That's why they are spending a lot of money on marketing and all of that. And they believe they can do more, which is why they are looking for money. So don't use trend alone. Yes, speak to the trend, right? But support it with some key ratios. In a question like this, that is just 12 marks. And this is the same thing that they asked them last day too, so they can come again this day. So we need to be smart about it, right? You don't want to waste too much time here. And your analysis to just go to the point, just so that at least worst case you are getting 10, 11. You have covered all the angles. You've spoken about the trend, you've spoken about fee ratios to support your trend, explain why the trend are moving in that direction and all of that. Then that's, yeah. Any other questions? So the third point asked us for forecasts. They said they want us to do a forecast of 2024 profits. Abi? Profit from just retail operations. Okay. I think we can do that because they already gave us a clue. So I can do a forecast of 2024. Let me start with the sales. Because from here, they told me that the credit sales will increase by 20% and cash sales will increase by 10%. Okay. So let me break this down into credit sales, which they told me is 70% of existing sales. But since they want me to do a forecast of just retail operations, so the existing sales is this 16,016. Okay, if I do 70% of that, whatever I get, I increase it by 20%. So increasing by 20% is like 1.2. Abi? Yeah, by 20%. And cash sales will increase by 10%. So if credit sales is 70%, that means cash sales is 30%. That one is increasing. I think they said 10%. Yes. Yeah, 10. So can you give me the figures, please?
Thirteen 453.44.
How about this?
13453. 45 years.
How about this?
5285.28.
Sorry?
5,285.28. 5,285.28.
So what's the total?
$18,738.72. 18,738.72.
Okay. We're told that our cost of sales also from the retail operations will increase by 12%. So what's the existing cost of sales? Well, we don't know, but we can get it. What's the difference between these two? 16,012 minus 16,016 minus 48. That's
11.
11,216. They will increase by 12%. So how much is that?
11,216 times 1.2.
12,251.
12 what?
12,561.92.
One.
561.92. 92.
Okay.
92. 92.
92. Okay. So what's my gross profits?
$6,176.8.
61.
76.8.
76.8.
Okay, I think they also talk about bad debts also. Um, they say related bad debt is expected to be 10% of credit sales. So bad debt is 10% of credit sales. And what's our credit sales? Is this? Ten percent of that we should be looking at
1,345.34.
okay. So what is the profit extract?
What? 4,831.46.
Okay, so that's it for this question. And the way I'm just trying to solve it for you is just to put myself, I'm teaching you as if I'm writing the exam to do exactly how you would do it in the exam. Okay? Because ordinarily I can do like a ready-made prepared solution, which will make the teaching very fast and all of that. And I'm reading analysis. No, it doesn't work that way. It doesn't work that way because if I do a ready-made one, then it will not reflect what you will have done in the exam. So this is a reflection of what you can do in the exam to get your maximum mark. Like in a practical way, in the light of the time that we have, right? So in the exam, you won't be explaining, you're just thinking, and I'm explaining to you the way I'm thinking about these things, then I'm writing it for you to see as it goes. I'm writing it in very simple and plain terms for you to relate, which is exactly what you do in the exam. Nobody is expecting you to cram anything. Just relate with the figures and numbers and speak to them, right? So there is still a lot of questions for you to practice. There's May 2024 here. The same thing. I'd write a memo to advising him to make investment, or whether the same qualitative factors, which will be talking about things like their corporate governance in place, so we're talking about things like employee motivation, talking about things like the quality of leadership, political stability, macroeconomic environment, their sales strategies. There are other factors that affect um, investments in another company beyond just quantitative. There could be qualitative factors as well, so which can also be considered. So look at these questions, practice them. Yeah, we can practice, you can share them with me. Let me look at the way you have written your analysis, right? And when I say practice them, I don't mean that these are all past questions. If you look at the question and you are going to read solutions at the back, you're not helping, you're not even reading. Analysis is a very key part of your syllabus. So you need to think, you need to be practical, know what you can do and do it yourself. So, because it's 20 marks, as much as you can pick that out of that 20, it helps you in passing this exam. Okay, so I'm doing my teaching. Um, Let me take question from Moses before I just make the final point so that we can go. Yeah, Moses.
Yeah, sorry, for the final, the last requirement, we carry out a profit forecast. You only carry adjustment on the underlying item. Then that means you assume that every other thing remain the same, right?
I'm not
Looking
assuming, I'm
at
just working. I didn't assume, I just worked based on the information given to me. They gave me a
okay.
business
So,
outlook.
but sir, if you go back to the profit statement given to us, we still have other statements now, have we? Yes,
Yes.
every other
So what do
statement
you
remains
want
the same,
to?
right?
No, it doesn't remain the same.
Distribution cost,
It doesn't remain the
administrative
same.
cost. Okay.
It doesn't remain the same. I cannot make any forecast because they didn't give me the data to make forecast. So, okay. And the question is very special. So you need to carefully read the question. They said you should do a forecast of 2024 profits for the retail operation using the business outlook. So this is the business outlook. This is the business outlook. It gave me sales will increase, a cost of sales will increase, and it gave me bad debts. And I use those three to do my forecast. And that is it. So don't do what we used to call oversabi and go and start doing what they did not ask you to do. Don't do that. Leave that. Let them think about that themselves. I don't want to think about it. So I've done what the examiner asked me to do, and I move on because it's 4 marks. I move on. I hope that helps you. So, we are doing well. January is gone. January is gone. Um, we are going to February. Um, we are going to me, I go straight to the point really in class. I don't really have so much time to be marrying around students and all that because we have a lot to do that the time is not even enough for me to cover up. So the only way I can know you, like I know Fashion very well because he participates very well. I know Sam and I know Moses and Mr. Hussein. So they participate almost on a daily basis. The others, I don't know you. So the only way I can know you is when you participate, when you send assignments, and some people speak to me off record also. I think David usually do that. He usually make a few comments to me and all that. So let's make our relationship worthwhile with those discussions relating to our school, nothing more. So your exam that you have and all that. Let's speak about that for the next, we have like 12 weeks more. February, March, April, 12 weeks. Maybe we can extend more to May, but I really don't want to do much in May because I'll be doing, what do they call it? Intensive for other students, people that didn't have time to, and that one is not even free. It's not even for you. You will have taught you go and read. So do intensive class for other people. It's usually like 2 weekends, solving past questions and all that. Now for you, um, February is for me is my peak. Second month is where I hassle you. Second month. Because I know after second month, then you are entering the second half. I don't like rushing those. I want to have done my hard work prior to that. Now I can see that we have a lot of work to do, and lucky for you, we have space on Sunday, and lucky for you again. That space you have on Sunday is exactly the time I take FR, which means you can join FR for a lot of topics that you need. A lot of topics that you're doing that you need, you can join them for that. For the whole of February, I would strongly recommend that we make that 4 weeks or 5 weeks sacrifice to start attending those FR classes. We're going to be using those periods to cover things like PPE and the introductory part of group accounts. Because the group at your level is advanced group, is complex group, foreign subsidiary, disposal, and all that. And truth be told, you cannot know those ones if you don't remember those simple. And those simple consolidation also is not easy to teach. It takes time to teach. So I would strongly recommend that you join those guys because I'll be starting group accounts with them from after this weekend, from next weekend, which is February. And I'll be teaching them, I'll start and finish their group accounts within that month. So in March, I'll start and finish your own group account in March, which is the other part of group. So if you join them in those using that period to be teaching you group and those other standards that I mentioned, then it gives you leverage greatly. Then we can use Tuesday, Wednesday, and Friday to be doing the other things that we have. Now we are done with ratio. Sustainability is still there that I'm still coming to, but we can move to IFRS 2, IAS 19, IFRS 8, IES 34, and those other key standards, financial instruments that are more advanced that are peculiar to IFRS 16 and all that like that. Advanced part of IFRS 15 and a lot of other ones that we can spend more time to address. So I would be sharing their links with you for you to join, and let's see. Let's work very hard in February. Let's see where that takes us to. I know it's going to take us far, but let's see where it takes us to in a very short time. We'll measure this at the end of February. Okay, so that's what I have for you for now. So I can see your hands up, Moses, David. David, your hand was up first, so can you go?
Good evening, sir. Can you hear me?
Okay, yes, now I can hear you, David. Please go ahead.
Oh, okay. I want to ask. You made mention of earning yield as a good ratio for investors. Like what other ratios is pivotal for investors, especially if you're looking at price or like capital gain, looking like price increase for a particular entity. What kind of ratio can you use to signify good indication that the company's price is going to rise?
I use P/E ratio for that.
Which one?
P/E ratio, price earnings ratio. The price earnings ratio.
Okay. So what's like what of like how will I ask the question? What price earning ratio is a good indication?
Sorry, again, what? I didn't get that. You said what price
What
earning ratio?
price Yeah, what price earning ratio is a good
Oh, okay,
indication?
okay. How that the level of P/E ratios that is a good indicator. So there is no specified level that we can see. What we can see is if it is increasing, if the P/E ratio of a company is increasing year on year, and compared to industry average, it is higher than most entities in industry. So we don't have a particular benchmark for that. Okay, like I explained when I was teaching you that a company with IP ratio signifies that investors have confidence in them, and this company would grow in the future, their revenue and all of that, and they would go up and that. But P/E ratio, yeah, is nice, but is more of investor sentiment. It reflects investor sentiment in a company. That's why you need to further look at other ratios like profitability, efficiency, and all of that to confirm the investor sentiment with that P/E ratio. But P/E ratio is a good measure, and there's no standard benchmark. You can only do a comparison, industry comparison, or year-on-year comparison. Yeah.
Thanks, sir.
Yeah. Okay, Moses, you can go now. You can ask
Yeah.
it.
Well, sorry. My question will be a little bit not what we're doing today. And it's something that happened in my office. And in fact, I've been cracking my head since last week in the area of revenue recognition. So
Okay.
I think the company make a sales, did a sale or a contract 5 years ago, but the customer did not pay the money, and the audited account did not recognize it as receivable. So in 2026, the customer now later paid the money in 2026. Now, when I recognize the entire revenue in 2026, and I carry out my trend analysis, and I saw significant increase. So I don't know how to explain that to the directors. So someone was telling me that probably I should take it and set it against my retained earning. Probably I will just debit my bank account and credit my retained earning so that you not affect the 2026 revenue. So I want to ask, is it a right entry, or I should pass it in 2026 entry as a sales?
So you can't pass it in 2026 entry as a sales
Okay,
one.
okay.
Yeah, you can't. So and so two things,
Mm-hmm.
the fact that receivables was not recognized is a major issue because
Yes, yes.
this, yeah. So the right thing to do first is to bring in that receivables, right? You bring in that receivables,
Yes,
you
I
bring
said four
in
years
the
ago.
sales. Eh,
4 years ago,
so
I don't have access to the audited. I don't even have access to the software that 4 years ago. They started the soft. They are using the software 2 years ago.
yes, I know, I get what you're saying. So you have to bring in receivable is a position thing, is a position. So as it is now, they were owing you at the beginning of the year. So you will have to do like maybe and for the opening balance, you need to bring in receivables and sales. So that sales now can go through retained earnings.
Okay.
That sales can go through retained earnings. So is the sale. All this will happen through a journal. Probably you can just do
Yes,
it and just into journal. Then that money that came in, then you can then debit bank and credit that receivables. You debit bank credit to net it off. But you need to get the invoice that originated this transaction.
yes. They presented the invoice to us.
Use that to record sales and revenue. But the sales would then go through retained earnings because you cannot recognize sales for the year. You would do a retrospective
Yes,
adjustment.
but they were telling me that retain any doing prior year adjustment. I should not do that. I don't have any right as an accountant. It's only auditor that can pass and a prior year adjustment to and to retain any. That me as an accountant, I don't have any right to do that.
Do your prior earnings. When the auditor come, let them do the adjustment they want to do there. But you do your books first
Okay.
in your management account. You have your management account. Pass your entries.
All right.
Then when they come, they will make their comments.
All right. It's okay.
Yeah.
All right. Thank you, sir.
Yeah.
Thank you.
Um. Yeah. Ayobami.
Yeah, good evening, sir.
Yeah. Good evening.
Yeah, okay, yeah, my question is about the FR classes. So
Again?
I look at, can you hear me, sir?
Yes, I can hear you now. You want to ask question about the FR classes, right?
Yes, yes, I look at the timetable for FR on Sundays, and I noticed that their classes their class are split into two. So I don't know which of them are we going to join, or are we going to join both?
For February, you most likely join the two.
Okay, okay, okay. Why it starts from February, right? From February.
Yes, from February. That's February. From their next class. From this weekend.
Okay, from this weekend. Okay, from this
Yes.
Sunday, this coming Sunday.
Yes. This coming Sunday.
Okay, all right, thank you.
You're welcome.
Salam is on the first.
Yes, on the first. Um, just try your best. Just try your best. Any inconvenience that has number attached to it is something you should ensure you go through because it will end like before you know it. So let's do what we have to do so that we would pass. Just so that we'll pass. All right, so bye. See you guys next class. Have a good one. Bye.